Hey, what's up, everybody? My name is Moss, and in this video, I wanted to tell you why I think that tech layoffs and layoffs in general are far from over. There's been approximately 220,000 layoffs since the beginning of this year in tech. But the primary reason that I think 200,000 layoffs still isn't enough for most tech companies is because of interest rates. But before I talk about interest rates, I quickly want to discuss exactly how do businesses grow and how do they increase their revenue year over year, especially publicly traded companies. If you're a publicly traded company, you are obligated by your investors to continuously increase your earnings year over year. And in order to do that, a company will have to invest in new areas of the business. Either that, or somehow they'll have to attract more customers to the currently operating parts of the business. And it might not be possible to acquire new customers in the currently operating parts of the business. So maybe you're a shoe company that primarily sells dress shoes, and you're fairly confident that the rate of new customers per year for your dress shoes is not going to drastically increase. And so, what are your options if that's the case? Well, you might decide that you want to expand the products that you're offering, and instead of selling just dress shoes, maybe you are also going to sell running shoes. But expanding your product offering is an investment. So, you have to invest in hiring new people, getting the right machinery, getting materials, and all of this costs money. So you have to take that money from somewhere, and you either take it from your profits from the dress shoe business or you borrow money. And if you're a publicly traded company, investors expect to see the same profit margins. So you're not really inclined to take money out from your profits. You want to borrow money instead and invest that, finance the investment using debt. If you're financing an investment like this, where you're expanding your business with debt, then you can continue to deliver the same earnings to investors that they expect year over year, while you're waiting for the new growth side of the business to make a return on the investment that you put into it. Now, here's where interest rates come in, and it's very simple. If you're a business that is looking to expand into new areas and offer additional products or services than the ones that you currently offer, you will look at how much it costs to borrow money. So if I offer you $1 million at a 1% interest rate versus $1 million loan at a 20% interest rate, your decision to invest in a new area of the business will be drastically different if I offer you a 20% interest rate or a 1% interest rate. As a business owner, you're going to critique the decision to invest in a new area of the business very heavily if the interest rate for the debt that you'll have to borrow is extremely high. Because when you service that debt, you're going to be servicing it with, money that should be going to investors. And at the same time, you don't know um, if the investment is actually going to pay off, right? So obviously what's going to happen is that when it's expensive to borrow money, you're likely not going to grow the business as often as you would if money was cheap and interest rates were low. Now, if you look at the last 10 years or so, following the Great Recession, money was extremely cheap. Interest rates were very low. And so businesses grew at a very, very fast rate. Since money was cheap, they didn't have to be critical of every single investment decision that they made to grow their business. And in fact, they were incentivized in order to be competitive with the rest of the market to make very risky investment decisions, since borrowing debt or borrowing money was cheap. And this fast rate of growth in companies also increased the rate of hiring. So over the last 10 years, you've seen the unemployment rate come from like 10% after the Great Recession down to a historical low, which is 3.5% or something like that right now. So obviously the inverse happens when debt is expensive. Companies are not growing at the same rate, and therefore they are not hiring at the same rate. And in fact, if they are not continuing to grow their earnings year over year, they might even decide to cut costs. And where do they cut costs? They cut costs with people. So over 2022 and 2023, you saw the tech industry shed hundreds of thousands of jobs in order to reduce their costs. And they've been positioning themselves because they know that they cannot grow at the same rate that they have been over the last 10 years because debt is now expensive. And one thing that I'd like to point out is that a lot of companies that were conceived within the last 10 years after the Great Recession have never experienced a monetary tightening cycle. And I think an indication of this is the rate of bankruptcies, specifically in 2023, that's increased at an alarming rate. There have been more than 230 corporate bankruptcy filings in the United States in 2023, and that's the highest number of filings since 2010. And I'll link to the sources for these numbers in the video description. Now, I'm sure that not all of those bankruptcies were tech companies, but regardless, when there is a high number of bankruptcies, it still has a ripple effect throughout the economy. Now, I've heard a lot of rhetoric online about how, corporate profits are driving inflation and that companies are making more money than they ever have. And that's true. If you look at 2022 corporate profits, they were at an all-time high. Companies never made as much profit as they did in 2022. But the problem for these companies is that interest rates are finally starting to take effect and they are eating into the profits, the company profits. And if you look at 2023 earnings for the first and second quarter of corporate profits as a whole, profits have been down from their 2022 highs. Now, if you look at it historically over since 2018, right, pre-2020, the profits are still much higher than they were in 2019, but they're on a downward trend. And that downward trend will continue as long as restrictive monetary policy is in place. So when layoffs were happening in 2022 in tech, that was like a proactive move by tech companies. They made a bunch of money in 2022. They made more money than they ever have in 2022, and they proactively laid people off. Now in 2023, the effective interest rates are taking place and they are losing. They're no longer making all-time high profits. And if that trend continues where their top line growth is fading, their only decision really, without being able to grow other parts of the business, right? Because they don't want to have to service expensive debt, is to reduce their costs. How do they reduce costs? Well, they reduce headcount. And I know that companies are going to opt for reducing costs and reducing headcount over investing in new areas of the business because one, debt is expensive and they can't guarantee a return on that investment and they don't want to take that risk. So they're taking a very conservative approach. But also, if you look at just recent data, specifically coming from the July Senior Loan Officer Opinion Survey, or the SLOOS, it showed specifically in the second quarter of 2023 that there have been tighter lending standards and weaker demand for commercial and industrial loans to firms of all sizes over the second quarter. So that survey data suggests that companies are saying, yeah, it's way too expensive to take out a loan and try to grow the business. And at the same time, banks are also tightening their lending standards, and they may not even if a business wants to grow, a smaller business might want to grow, they're tightening their lending standards, and you might not get as much money if you're a business, or you might not get approved for a loan at all. And if you paid attention to the most recent Federal Reserve FOMC meeting, they basically said they're going to be holding the interest rates higher for much longer than most people anticipated. So we are not in an environment where there is going to be an increase in job openings. There's only going to be a decrease in job openings, and there will also be a decrease in headcount at a lot of tech companies and companies outside of tech. And it's no secret, like the Federal Reserve has been saying that their expectation is that the unemployment rate will increase. And another thing that I want to point out as a headwind in tech specifically is the lack of innovation in tech. There has been movement in cryptocurrencies and blockchain technology over the last several years, and companies hopped on Web3 and crypto because they thought that that was going to be their next, golden goose that was going to make them a bunch of money. And now nobody's talking about Web3. Nobody's really talking. I mean, they still talk about crypto, but you don't really hear anything about like, blockchain technology or Web3. Meta has, where's the metaverse? Why you don't hear them talking about the metaverse very much. I know they did release recently like a new Oculus Quest or something like that, and it does look like they're continuing to work on that to an extent, but it's not like they're not super excited about it. What they've done is they've pivoted into AI this year because they saw all of the consumer excitement around AI and what ChatGPT did. And now you heard on the first and second quarter of earnings call, pretty much everyone talking about generative AI, and none of them probably even know what it means, but they know that all they see is dollar signs, right? And so they keep chasing after AI. And how long will it last? I do think that generative AI and ChatGPT has provided real value and will continue to provide real value. But the number of companies that are actually going to profit off of that technology is going to be only a handful. And it'll be companies like NVIDIA, who are basically selling the computing power for AI, and other companies like OpenAI that are defining the models used in order to run um, these services like ChatGPT. And I'm going to link an article that's pretty interesting in the video description that talks about the slowing of innovation in tech and how big tech is kind of hampering the ability of smaller companies to disrupt the tech industry with new innovations. But if you look at the last, few years of what big tech has released in terms of products and services, I think it's clear. I think it's becoming clear to people that there hasn't been a lot of innovation. And I noticed in Apple's most recent event where they released the latest iPhone, a lot of people were kind of memeing it because it was just like it was the same thing. It was like a barely incremental improvement over the last iteration of iPhone, still wildly expensive, but not a lot of improvement. I'm sure if you compare the current iPhone to like one of the very first versions, yeah, those incremental improvements have add up, and it's a massive improvement. But in general, there's no the innovation that was the initial release of the first iPhone, right? We haven't seen that kind of innovation in a long, long time. We haven't seen any companies come up with that kind of innovation. So I don't know. I just think that we're we're heading for a period that is going to be very difficult for tech workers, and we're going to see more layoffs happen in the future in tech and across other industries. Now, I know I've just been radiating positivity this entire video, but I guess it would be worthwhile to uh, quickly end the video by talking about how you can prepare yourself for a period where there might be additional layoffs in tech and maybe a higher rate of unemployment. I actually recently posted a video that addresses this in more detail, and I'll kind of link it so that you can navigate there directly if you do want to watch that video. But at a high level, the main points are that you should upskill yourself with new skills and technologies to stay competitive. You should be paying attention to job trends and like what tools are becoming more popular, what technologies are becoming more popular that are related to your role, and you should evaluate your value within your company versus your value across companies. And I think for a better explanation, do check out the video that I linked, and pay attention to the economy, which is what I've been talking about here. Keep an eye on interest rates, the economy, things that might affect the industry that you work in. And also be sure to network and try to grow a network of professionals that you could potentially lean on if you did get laid off. And then I think the last piece that I covered in that video is to maintain an emergency fund, just to ensure that your finances, you have a buffer if you were to be laid off. I hope you found this video helpful. If you did, please consider throwing a like on the video and subscribing to the channel for more videos like this. Thanks for watching.